So, welcome back. So, as you know or are well aware, we were discussing about convenience yield, dividend yields, risk free interest rate, and based on that we are trying to find out the value of small f or capital F, which is the value of the forward and the forward price. So, this is basically the PPT slide which you see is basically the assets, different type of assets. The first one being provides no income, provides fixed income which is I0 as of now and provides some dividend yield, and the second and the third column are basically the value of the forward and the forward price. So, few very simple examples. Suppose that the risk free interest rate is 10% per annum with continuous compounding and dividend yield calculated being 4% per annum. The index is standing at 400 and the future price for the contract deliverable is 4 months is 405. So, whether there is arbitrage opportunities, you have to say yes or no. So, remember risk free interest rate is given as 10% per annum, then the dividend yield which is basically Q is given by 4% per annum. The index standing as of today S0 is 400, the contract delivery in 4 months where the time period is now 4 by 12 time period T is given at 405. Based on it you find out whether this 405 is less than or greater than equal to the value which you have found out, which would be S0 into e to the power in the bracket R minus Q into T. So, T if you should remember, it is basically 4 months which is 4 by 12, R is 0.1 and Q is with a minus sign would be 0.04. Based on that you can find it out, and S0 as I mentioned is 400. Coming to the next example, the 2-month interest rate is in Switzerland and United States are given at 3% and 8%. Remember, if I am standing in Switzerland, then my domestic currency is Swiss franc and the interest rate is 3% and the foreign currency is United dollars, hence the interest rate is 8%. And if I change my position, if I go to US, then US would be the domestic one, Switzerland would be the foreign one. The spot of Swiss franc is given as 0.06500. So, depending on where you are, you will basically try to find out the foreign rate based on the domestic one. So, if you are in US, then obviously you will quote the price accordingly, or if you are in Switzerland, you will quote the price accordingly. The futures price is given for the contract in 2 months is 0.6600. So, whether there is arbitrage opportunities for that, you have to basically find it out. So, remember the time frame is given as 2 months, which is 2 by 12, and in this case remember very categorically. So, if you are using the Swiss franc in dollars spot S0 as 0.65, then obviously e to the power that R minus R star would be the corresponding interest rate, where R would be for the domestic one, R star would be the foreign one, and then you will basically calculate and find this value and compare with the value of 0.6600 and then say whether there is arbitrage opportunity is there, yes or no. In case if you change your position, you go to the other country, then the corresponding values would be very simply calculated. Spot now would be 1 by 0.65 and the futures would be, the value would be 1 by 0.66. Time duration remains the same, which is exactly equal to 2 months, which is 2 by 12, but now the R and R star would just be the reverse. So, if in the first case if it was 3% and 8%, now it will be 8% and 3% depending on how you are trying to look at the diagram or the whole situation. Now, I will cover the following concept, which is types of interest rate, what we mean by zero rates, bond pricing, forward rate calculation, interest rate, par yield and so on and so forth. So, I will go very slowly and with examples so that you can understand it clearly. We will discuss, as I mentioned, the zero rate, par yield, forward rate, day count conversion, interest rate future markets and treasury bond futures. Now, before that we will consider two simple concepts, which is the LIBOR and the LIBIT, which in India we have the MIBOR and the MIBIT. So, LIBOR means London Interbank Offer Rate and LIBIT means the London Interbank Bid Rate. In India similarly you have the Mumbai Interbank Offer Rate, which is the MIBOR, and the MIBIT, which is Mumbai Interbank Bid Rate. So, this basically this means the amount of money which is being exchanged by banks, what is the interest rate which is being charged. So, obviously you will think that why there are two different interest rates. So, if you remember, if you go to the bank and if you deposit money and if you withdraw money, the interest rates are different, or if you go to the bank and sell dollars or buy dollars, the rate of which you will sell and buy are different. So, in the similar way they would be MIBOR and a MIBIT depending on what is the interest rate of buying and selling in India. Similarly, different foreign banks when they trade, they basically trade that based on the LIBOR and the LIBIT. So, repo rates are also would be found out later on in the problem is the basically the repurchase agreement, and depending on the repurchase agreement which has happened between two financial institutions or the banks. And examples of the reports rates can be overnight, they can be term repo rate, they can be for a weekly basis, so on and so forth. That means I give some money, I want to repurchase that amount of money. So, what is the interest rate which is being charged? So, remember one thing, if the demand and supply is very fluid, there is some symmetricity in the market, then the difference between the MIBOR, MIBIT, LIBOR, LIBIT and all the buying and the interest and the selling interest rate is very small. The more the difference in the demand and supply is, greater would be the price differences, we will see later on, and also time frame also plays a big factor. So, as on 7th August 2006, these are actual data. Whenever I am basically giving some information on the data, they are actual data which I am taking for the net. So, you have the MIBOR and the MIBIT rates are given, the overnight is given at time 9:40, then 14 month at 11:30, 1 month at 11:30, 3 month at 11:30. At the time of the trading, and the third, fourth, fifth, sixth columns are MIBIT and its standard deviation, MIBOR and its standard deviation. So, if you look carefully, as the time increases, hence the MIBOR and the MIBIT interest rate also increases, which means in a way that time has some amount of uncertainty, hence people would like to basically have a higher interest rate. But on the other hand also, if there is a high interest rate, there is huge amount of fluctuation. So, that dispersion is basically subsumed and the picture comes out very clearly if you see the standard deviation. So, standard deviation for MIBIT or standard deviation for MIBOR for overnight one or for the 14-day one when compared with the 3-month one is very low. That means, for 3 months as you go down the line, the MIBOR and the MIBIT in standard deviation basically increases. Similar would be the case for the LIBOR and the LIBIT. Now, we will find out the n year 0 rate or n year 0 rate or n year spot rates. Note, for calculation we will try to find out, we will consider there is no intermittent payments is being paid, that means there is no coupon payment. Rates on government bonds are not exactly equal to the rate, as the government bonds have intermittent payments of the coupon rate which is being paid by the government bonds. So, now the question is that how do you calculate the price of the bond? If time to maturity is in T years and it pays semi-annual or quarterly or monthly or daily or weekly interest rate, whatever it is there, or coupons, remember the 0 rate for different maturities used to calculate the value of the coupons at different times are not equal, and they may change because of reasons of time frame and volatility and fluctuation which is happening in the market. The yield on a coupon bearing bond is the discounted rate that equates the cash flow based on which you are getting exactly equal to the market value. So, there are two things, one is basically the bond pricing, how we will do that, and another thing is basically yield on the coupon based on which you will try to find out what is the value of the bond such that the demand and supply exactly matches, considering that some coupon payments are being made. But for the 0 coupon one, we will consider the 0 rate is based on the fact that there is no intermittent payment which is there. So, given one you can find out the other or vice versa. So, now consider the bond pricing example is given, and see here the second column very specifically mentioned is the 0 rate. So, these are the 0 rate means there is no coupon payment is being made. On the first column you have the time, they are in years as always. So, you have half year, 1 year, 1.5 years and 2 years, and the 0 interest rate are continuously compounded per annum are given as 5.0, 5.8, 6.4, 6.8. Again you will see as time increases the 0 interest rate also increases. Now, what does this 5, 5.8, 6.4 and 6.8 means? It means that you have basically invest any money for a time frame of half a year, the interest rate based on that, considering there is no intermittent payment for the principal amount would be 5%. If you put that money for 1 year, considering there is no intermittent payment, the principal amount basically now gets you an interest rate of 5.8% per annum continuously compounded. So, these are continuously compounded interest. Similarly, for 1.5 year you put that money, no intermittent payment, the principal amount increases by the interest rate of 6.4% per annum continuously compounded, and similarly for the value of 6.8. Consider an example where you have 2 years maturing treasury bonds with the principal amount and the face value which is given is 100, and it provides a coupon at the rate of 6% per annum, with coupons being paid semi-annually. So remember this word, they are being made 6% per annum, which is the coupon is being paid twice in 1 year. So, one after 6 months, another after another 6 months. We have to find the price of the bond as of today based on the interest rate chart which has just been shown to you. So, now let us come to the calculation. So, calculate the cash flow or the total amount of cash which is been given back to you. Remember, once the clock starts, after 6 months you will basically get that some amount. So, what is that amount? First you will note the amount is 6/2 because you are being paid semi-annually and the coupon rate was 6 per annum. Now that 3 rupees, $3 whatever it is being paid after 6 months has to be brought back as of today and try to find out the overall value. So, what you do is that for the 6-month period, which is half a year, the interest rate was 5%. So, basically you multiply it by 6/2, which is the $3, by e to the power minus r, which is minus 0.05 into t. So, t is the time frame, which is basically 6 months, is basically 6/12, which is 0.5. Now, second, the total duration was basically given as 2 years. Now, you will find out the second coupon is being paid after 1 year. So, what is the total amount of coupon payment? 6/2, which is 3, but when it is being paid? After 1 year. So, if you find out the value as of now, it will be 6/2, which is the amount, into e to the power minus RT. R is now not 5, but is 5.8 depending on the interest rate, which is for 1 year, and T is not 5 months, if 6 months is basically 1 year, hence it will be 12/12. Now, if you go to the 1.5 years, again you will find same coupon. Now, the actual interest rate would not be 5, not be 5.8, but it will be 6.5. So, it is 6/2, which is the coupon value, into e to the power minus 0.064 into the time frame, which is t, which is basically 1.5 years. And finally, when the total time duration comes, you will get the coupon, that is true, which is 6/2, plus you will get the face value. So, the total amount of money which you are getting back after 2 years is 100 plus 6/2, but when you basically bring it back to as of today. So, now you are basically trying to utilize two different things. Time frame is now 2 years and the interest rate is not 6.4, is basically 6.8. So, your actual calculation would have 100 plus 3 in the bracket into e to the power minus 0.068 into 2, and that value comes out to be 98.39. Now, given this 98.39, you want to find out what is the bond yield. That means, what is the intrinsic value of the yield of the bond which is coming back to you. The bond yield is the discounted rate that makes the present value of the cash flow of the bond equal to the market price of the bond exactly. Suppose the market price of the bond in our example is as given as 98.39, then you want to find out what is the basically the bond yield. Now, bond yield is basically the intrinsic value of the coupons which is happening. So, if you remember, we have said that the coupons are being paid 6 months hence. So, considering the bond coupons which you are getting back is 6. So, it is basically 6/2, but now if you consider the bond yield, initially it was 5 for 6 months, now you will consider a constant yield rate, which is basically y per annum on a continuous compounding interest rate. So, it will be 6/2 e to the power minus y into half. The second term is again value of money which you are getting after 1 year, it will be 6/2 into the e to the power minus y into 12/12, which is 1. The third you are getting back after 1.5 years, it will be 6/2 into the power minus y into 3/2, which is the time duration 3/2, and the last one again you will have the coupon payment, which is 6/2 plus 100. So, it is 100 plus 3 in the bracket into e to the power minus y into 2. So, hence the value comes out to be 98.39, which you already assumed to be true. Based on that, you can find out the bond yield as 6.75. So, remember one thing, the more the bond yield is, lesser with the value on the right hand side, less the bond yield is, more with the value of the bond yield, the value on the right hand side. So, the yield comes out to be 6.76% per annum continuously compounded. So, there are different methods or Newton-Raphson methods, Runga-Kutta method, different type of iterative methods. Using this, you can find out the bond yield as done in our example. Now, the third question we will try to answer, what is the par yield. So, par yield of a certain maturity is the coupon rate that causes the bond price to be exactly equal to its face value. So, if you remember, the face value is not the value of 98.39, which is the demand and supply price based on which the market price is dictating for the bond. Face value is the value of the on the bond which is written, which technically we consider as 100 or 10. So, in this case it is 100. Now, we will consider the par yield based on the facts as that is exactly equals 100. So, you have to find out basically the interest rate which is already given in the table. So, for 6 months it was 5%, for a time duration of 1 year it was 5.8%, for 1.5 years it was 6.4%, and for a time duration of 2 years it was basically 6.8%. So, you will utilize that value. Now, using the par yield of a fixed value of C. So, now if you remember, we have mentioned very categorically that is being paid semi-annually. So, the C amount would be paid after 6 months, which is C by 2, and the interest rate based on which you will find out, and the time duration would be now 5% and a duration of half a year. Second, again you will get back after 1 year is C by 2, and the interest rate is again 5.8% and 1 year. Third one, again you will get back is C by 2, and the interest rate and the time duration is 6.4 or 1.5, and the last case you will get back the par yield plus the principal value, which is 100. So, that would be multiplied by the interest rate e to the power minus the interest rate, which is 6.8 percentage per annum continuously compounded, then the time duration is basically 2 years. So, if you equate it to the face value, the value of the par yield comes out to be 6.87. So, if you compare the value of 6 and 6.8, it will give you whether the bond is doing well and good, or it is not definitely not doing good. So, in the first case with the coupon payment of 6, your actual value face of the bond was coming out to be 98.39, and in this case is exactly equal to the face value of the bond, which is 100. So, now if you compare the value of the bond and as well as based on the par yield and as well as based on the coupon payments, then you can make a decision whether the demand and supply of the bond is such that you will definitely invest in that or you will not definitely invest in that, depending on what the interest rate is. But remember also the interest rates are fluctuating. Remember also the yield rates are also fluctuating. So, you have to basically make a judicious decision based on the coupon payment, based on the par yield, based on the interest rate, and based on the yield of the bond, such that you can basically make a profit or a loss depending on what your actual scenario is, whether you want to basically increase your risk, decrease your risk, increase your return or decrease your return. Now, in general the par yield calculated by this value formula, where 100 is the face value, that is equal to A into C by M plus 100 into D. Now, what are these values? M is the number of coupons which is being paid. So, if you remember, C is the par yield which is being calculated, and here there in our problem we consider semi-annually. So, M was 2. So, M is the number of coupon payments which is happening per year. D is the present value of $1 received and maturity. So, if 100 is the value, so it will be 100 into D, which is the present value of the total amount which you are getting, and A is the present value of an annuity of $1 on each coupon date payment. So, obviously, we will multiply that amount, that is C by M, coupons which is being paid, multiplied by A, such that you can basically balance the equation. So, exactly this is the same thing. You will basically have coupons which are being paid at for some interval. Then at the last stage you will basically have the coupon plus the principal amount. So, if coupons were being paid once in 1 month, so obviously coupons would be C by 12 first month, again brought back as of today, then it will be C by 12 for the second month brought back today, continue doing this till the 12th last term, which will be now basically consider 2 terms. One is C by 12 plus 100, which is the face value. So, obviously, the interest rate would be for when you basically find out the present value of the first coupon which is being paid after 1 month would be that present value would have basically 3 terms. One is the coupon payment which is being paid, which is C by 12 multiplied by e to the power minus the interest rate would be for the 1 month multiplied by time duration would be 1 by 12, that is 1 month. Similarly, for the next case it will be the coupon payment would be multiplied by 2 terms, e to the power minus r, where r is the interest rate for 2 month period multiplied by the time, which is basically now 2 month period, which is 2 by 12. You continue doing it, and the last sense the value which you will have would be 100 plus C by 12 in the bracket e to the power minus interest rate, which is for 1 year multiplied by 12 by 12, which is the time duration. In the continuous compounding sense, again you can convert it in continuous compounding sense given by these values, where RC is the continuous compounding rate, RM is the equivalent rate with the compounding m number of times per year and calculated percentage per annum, n is the number of years and m is the number of times of compounding. So, if you go back to the actual formula which you have already discussed, Either you have the continuous compounding interest rate or you have the compounding interest rate done m number of times, whichever it is, you can convert one formula to the other and do your calculations accordingly. But remember very clearly that it is best to do all your calculations on continuous compounding rate, but also remembering the interest rate which is given should basically be specific on two accounts. One is it is percentage per annum and it should be continuous compounding. If it is percentage per annum, but compounding is being done m number of times, so you will immediately convert it into a continuous compounding case and do your problems accordingly. Now you want to determine the zero curve. So in the first column, consider you have the bond principal amount, you have the time to maturity, second column, third one is annual coupon rate, and in the bond price in dollars. So whatever the value is. Now before I proceed to the problem, let us pause and see what values are given. Bond principal amount is basically the principal amount of the face value which you have written on the bond. So this is always 100 or 10, whatever the value is. Now time to maturity is given. First is 1/4 of a year, second is basically half of a year, third is 1 year, fourth one is 1.5 years, and fifth is 2 years. So all the time durations have been converted into time duration in years. It could have been in months, it can be in weeks, so on and so forth. So if it was given in weeks, so if it is 3 weeks, it would have been 3/52. If it was in months, so obviously as you know, it will be number of months divided by 12. If it is days, it will be number of days divided by 365. So whatever it is, you are trying to convert the time duration on a time scale of year. Third column is the annual coupon rate. So in the first cases, 3 cases, you see there is no annual coupon rate because they are all 0. Now in the fourth and the fifth, you see the annual coupons which are being paid is 8 at 12. But obviously your next question will be, if they are annual payment, are they being paid annually? Are they being paid semi-annually? Are they being paid daily? Are they being paid quarterly? So whatever it is, that will be very clearly specified in the problem. And the bond price, considering very simply, they are the actual demand and supply price based on which you are trying to dictate and try to find out what is the interest rate. Given the zero curve has to be found out, and given the forward rates have to be found out. So you will find out both of them. Now we assume for this problem that half of the state trade coupon is assumed to be paid after 6 months. So for the fourth one, the $8 would be paid in 2 halves, 4 and 4 after 6 months. And for the last one, it is $12, it will be $6 per 6 months, then $6 in the next 6 months, then $6 in the 1.5 year, and when the time duration comes for 2 years, the principal amount which is 100 plus $6 will be paid back to you, and obviously you have to find out the present value of the total money. So in the first case, let us do the problem. In the first instant, the amount which you will be getting is 100 is the face value and 97.5 is basically the demand and supply price. So this is difference is 2.5. Now you will ask yourself, this 2.5 can be earned on 97.5 if you buy today. But in what duration? Duration is 3 months. So what you are trying to find out and try to understand is that this 2.5 will be earned by you on an actual investment of 97.5 on a 3-month period. So hence the 3-month interest rate is 4 times this value, because it will be paid 4 times in a 1 year if you basically expand the time scale from 3 months to 1 year. The interest rate comes out to be 10.25. This is percentage per annum, but remember very clearly that these payments were being made after 3 months. Hence you will say this is 10.256 per annum interest rate being compounded quarterly. So the number of times it is being paid in a year is 4, m is 4. So obviously we will try to convert into a continuous compounding interest rate. So we use the formula which you have already done. Based on that, we find out the value comes out to be 10.127. So with this, we will end the class today, but I will just reiterate what we did. So given the face value, given the coupon payments being done, given what is the demand and supply price, we will first step and found out what is the continuous compounding interest rate for the zero coupon loan for 1/4 of a year, and based on that we will proceed to find out the continuous compounding interest rate and the forward rate for the subsequent calculations, such that we are able to understand what does the zero rate and what does the forward rate give us the information about the bonds. Thank you very much.